What's going on, family? This is not financial advice. Do your own research, man. We're gonna be checking out some market psychology, man, and why this is important. It's even more important than having a good strategy, man. So, as you can see, we got a hammer. They bounced off of the 200 on the S&P. We got gaps left behind on the S&P to be filled. We got a fib level that they rejected from, and we could come back up to fill these gaps and even make a lower high up here in this zone. So we'll get straight to it, man. And I'm gonna kind of identify these levels ahead of time. So we got gaps, huge gap from here to here, from 4078 to 4053, and then we got a gap from 4090 to 4078. So got gaps to fill. Then we have another huge gap all the way up here from 4148 on down to 4037. We got a lot of gaps to fill, man. And oh my man, I forgot even about that one way up here. We got plenty of gaps to fill. I forgot about this one as well, way up here at 4063. So we got plenty of gaps on these charts that have to be filled. We don't know when, but we know that they could possibly come back up really soon. So got a lot of gaps to fill on these charts. Very bullish move, leave a gap behind. So you know they're coming back to fill that. So this could be just retracement of this bigger downtrend before they push lower. So I'm gonna get on down to a smaller time frame so we can see exactly where these key levels were that I drew. So let me go a little bigger time frame. Okay, here we go. So these orange lines, these were the key levels that I drew. Got one here at 4016, one here at 3945. So this was the range that they were in. And as you can see, what I highlighted, they finally mounted this area and began to push higher. So the first target would be 4052. They break 4052, then we have nothing but room to push on up to fill this gap up here at 4078. So that's what we're looking for. A gap filled is the first target. If we continue in this uptrend, that's the first target. So, market psychology, why is this important? So, first off, what is market psychology? So, market psychology is refers to the ability to identify and manage emotions and behaviors that may arise when trading. So, 90% of traders fail because of market psychology. The reason being is because the market plays on your emotions. So, one thing that we have to identify is what is one thing that we can identify with that messes with our emotions. So, colors. So, colors affect our emotions. So, they have a study here to how we associate with these colors. So, we're just going to go over the candlestick colors. So, most of the time, red symbolic meaning is passion, excitement, and love. So that's a symbolic meaning for red. So the green candlesticks, color green, identify with nature, growth, and freshness. So those are the symbolic color meanings. So how we identify with them as humans, and red. So red will be the first one. 68% associated red with love. 39% link green to contentment. So when we get a little deeper, red is used to stimulate the body and mind to increase circulation. All right. So we got the red stick candles and the green candlesticks as well. So we can see how colors affect our muscles. So when we see a big red candle, we get excited and you know, we expect the market to drop. We see a green candle, we also get excited and we expect nothing but upside. So it's a lot to market psychology. We know that the market is often swayed by factors which influence trading psychology on an individual and on a collective level. So we know the market is manipulated, especially when it comes to expectations. So when we expect the market to do something, it usually doesn't. And when people expect the market to do the opposite, it usually does the opposite. So it kind of plays on our emotions, especially when losing a trade. So when you have your money on the line, and we're gonna get to this chart real quick. So a trade that I took particularly, and the reason I stopped trading after this was because of greed. So greed can affect our trading. So when I seen this was the last trading session. So they had a gap up in the trading session. They came down, they double bottom, huge engulfing candle. And once I seen this move, this engulfing candle, once they engulfed this candle, this was my entry. And I was able to capitalize on this push all the way up until about 12:30 to 1 o'clock. So that was the trade that I took. Um, and I left my runner on. So I took profits here and I left my runner on for the rest of the day until about when the market just kind of chopped sideways. I just kind of took profit. I didn't trade all the way to 3 o'clock. So around 1 o'clock, I took profit. So that'd be around this time. And I was done for the day. So I only took that one trade, engulfing candle. They did not come back to fill the gap. This was my entry on this engulfing candle on up to around 1 o'clock. So that was the only trade I took Friday. So reason being is because you can get greedy. Once you see how much money you can make on a move like this, I'm gonna just highlight it from here. So this was my entry was at 40. We're just gonna say 40, 40 10. We're just gonna say 40, 40 10. We're just gonna say 40.09. So 10 points all the way up to 40.20. Right. So that was 10 points for me. And then they kept going on up to around 1 o'clock. So that was 32 points that I made on this one trade, 32 points. So if I would have never took profits here and I would have never kept any runners, I would have made plenty of money. So when you see these green candles, you get excited. So you want more, you want more. But it's not about how much money you make. It's about taking the money that they offer you and then running because you expect the market to continue to push once you see moves, aggressive move like this. So that's the market has a target. So the target was 40, 38, 40, 40 area. That was the target, and the market's target. And the market did not stop until it reached that number. So on the other side, the downside, if we see like this red candle right here, we want to just go to this day. If we see this huge red candle, this is the same line I had a resistance. When we see this bearish move down, the market is coming down. So when we see a move like this, now we want to sell because we get excited about how strong the move was. So when we have a losing trade, let's just say we bought up here and it came down and stopped us out. And we see this huge move. So now we want to get our money back. So now we want to aggressively trading now. We're not looking at what's happening. We're just aggressively trading. So we're buying down here. We bought this move. Say we bought this. We got a big old rejection candle. We bought this. They came back, stopped us out again. That's time to stop. So when you get two losing trades in a row, it's time to stop and it comes to emotions, we don't do that. We take our losses and then we leave. That's what we're supposed to do. But since we are emotional creatures, we want more. So then we continue to trade. We're trying to figure out setups to get our money back. Now we haven't switched our bias yet. We're still trying to buy back because we've seen this huge move up. So now the market is correcting and now we see this push down. Now we sell, but it's too late to sell. So they come back and they stop us out because we sold. So it's a lot of just triggers on our emotions. That's why 90% fail, man. So use these key levels, take your money and run. So just to get in an idea of what market psychology is. It's more important than a strategy, and you have to stick to it and trade without emotion. It's difficult, but we have to learn how to develop patience in this market, and then we'll only be successful. So hit like, subscribe if you like this content, man. Keep it pumping. Join the Discord, and we'll keep you going with this content, man. I'll see you guys tomorrow. Out.